Hi everyone, welcome to the session. In this video, I'm going to discuss about one of the investment appraisal methods, that is payback period. So let me move on to the session. What is a payback period? Payback period simply means it is a time that is required for the cash inflows from a capital investment project to equal the cash outflows. In other words, how long will it take to recover the initial cash investment on a project?
So what I'm going to do is I'm going to show you and calculate exactly how long in years a project takes to recoup initial investment. So in order to explain the payback period, let me take this example. AG considering a new project which will require an initial investment of US dollar 70 million. The estimated profits before depreciation are as follows. So this is very important. Estimated profits before depreciation are as follows. Now you are given set of information. You are given the cash flows from year 1 to year 5. So these are the years that the project is going to run, and these are the respective estimated cash inflows. These cash inflows are before depreciation. Now when you calculate the payback period, you need to identify the net cash flow. So you need to identify net cash flows. So what does it mean? So if you are given profit after depreciation, so you need to add back the depreciation. So basically when you calculate the net cash flows, you should identify the net cash flows before non-cash items such as depreciation, overhead allocations, etc. So if you find any depreciation or any overhead allocations are deducted from the cash flows, you need to add back to identify the actual cash flows. In other words, net cash flow means it is the revenue minus cost attributable to the project. As you can see, our initial investment is 70 million. Our cash outflow is 70 million. Now, to calculate the payback period, what we need to identify here is point at which the 70 million will be paid back. So this is what we need to identify. So in order to do that, as you can see, these cash flows are given over the project life of 5 years. So based on these cash flows, we need to identify the payback period, the point at which the 70 million will be recovered or recouped from these cash flows. So in order to identify, what we need to do is we need to prepare a statement. We need to calculate the cumulative cash flows. So let's calculate the cumulative cash flows. So this will be the cumulative cash flows. As you can see, year 1, the cumulative net cash inflows will be 20 million. At the end of the second year, your estimated cash inflows will be 30 million. So cumulative will be 30 plus 20, that will be 50 million. So likewise, at the end of fourth year and fifth year, so when you add the respective cash inflows, so that will give you the total of 200 million at the end of the fifth year. However, in this case, we need to identify at which point 70 million will be recovered from these cash flows. As you can see, at the end of first year, AG PLC has earned 20 million. So which means out of 70 million, still AG PLC has to recover or recoup 50 million. In the second year, the company has earned 30 million, which will make the total cash inflows to 50 million. So at the end of the second year, the company has in total 50 million. So out of 70 million, company has earned 50 million. So therefore, how much is left to be recouped? 20 million. Further, the third year, the company has earned 40 million. So which will make the company's total cumulative cash flow at the end of the third year 90 million. Which means 20 million is fully paid back during third year. So basically, 70 million of the investment. So 70 million of the initial investment is recovered in between second and the third year. Supposing, let's say, at the end of the third year, the cumulative cash flow was 70 million, then we can say the project has paid back the initial investment. The project has paid back the initial investment at the end of the third year. But in this case, we can't exactly say, we can't precisely say that the initial investment of the 70 million has been paid back at the end of the third year, because it is recovered in between the second and the third year. Therefore, in order to calculate the payback period, so what we need to do is, we need to, since it falls between second and the third year, we need to identify proportionately. So how we can identify? Now we know at the end of the second year and at the end of the third year. So basically it will be 2 years plus proportionate amount from proportionate years from third year. So what is left to be recovered at the end of the second year was 20 million. So this is the 20 million. So this 20 million is recovered from the third year estimated cash flow of 40 million. So therefore, we need to take the proportionate amount from this 40 million. So basically, it will be 2 years plus this 20 million to be recovered from 40 million. So this will be 2 years plus 0.5 years. Basically, we can say 2.5 years. Now, instead of taking 0.5, if you want to present this in number of months, so what you can do is, you take 2 years plus simply you multiply this 0.5 by 12. So that will give you 2 years plus 6 months. So precisely the 70 million investment will be recovered after 2 years and 6 months. So with that I will conclude the session. So if you want to watch more videos on accounting and management accounting, so what you can do is you can subscribe to the channel and you can hit the notification bell to get regular updates whenever I upload a new lesson. So thanks for watching. I'll see you soon with another topic. Bye for now.